of charts right here, and we're basically going to go over some successful trades. This would be the successful trades. No, this would be the back tested trades. This would be the successful trades, and this would be upcoming trades, right? So, to understand the strategy we use, I've created this little chart that basically explains the idea. So, in the market, I like to view the market from a perspective that suggests the market could be in three different phases or three different locations, right? We have what we call the novice space, where there's an equal amount of buyers and sellers, or a relatively equal amount of buyers and sellers, because the market is majority, well, the market is made up of supply and demand, people buying and people selling. That's what moves the market. That's what the market is made up of, right? So at different points and different locations in the market, we would have what we call the novice space, where orders are being filled, where there tends to be, a relatively equal amount of buyers and sellers, right? So this is where most people would buy and sell, right? And then we have supply, which would be what we would call retail prices. This simply means this is where the majority of sell orders are, and a lack of buy orders. And this is where we expect the price to turn, right? Because if there is little buying and lots of selling, the price is going to go down. If there's equal amount of buying and selling, price is going to go sideways. And if there's more buys than sells, which is demand, wholesale price is likely to go up. And this is how I would view the market, right? This is all that is considered in this training, and let's just say every time frame is unique. So this would show up on every time frame independent of each other. So let's go through some examples of trades that worked out using this methodology. First of all, you need to know how to identify supply and demand zones. And this method just shows you which zones are likely to work and which zones aren't. So here in this scenario, this was a back-tested trade, which means I replayed the market to a random date where I wouldn't know what would happen next. And then I marked up the charts and tried to predict what would happen. And then I would press the play button to see whether or not I was right or wrong. So this was Sunday, 5th July, June 22nd. In this scenario, we have the market going up, which is rally. Let me use a smaller market tool. Okay, so let's just follow the market. We have the market rallying up. This rally, every movement in the market has meaning. This rally means there's more buyers than there are sellers, and the market needs to continue up until it meets sellers to match the buyers, right? Because you need sell orders to match buy orders and buy orders to match sell orders, right? So once the market gets here, we see it based for 2 candles, which simply means at this point in time, for 2 candles, right, for 2 hours, there was an relatively equal amount of buyers and sellers, because that's the only thing that can make the market go sideways, because 2 candles in the same spot simply means the market went sideways. However, we had a strong, sharp move up, which means that there were no more buyers at that price. There was no more sellers at that price, and the market had to spike up in order to find sell orders to match the buy orders, right? So what does that mean? it takes a lot of money to create this move, right? And we know that from this move until it gets up here, all of this is buy orders, right? And it's not until the market gets to this level that, sell orders are met. Now, the amount of money that it takes to create this move and how the market departed that area would suggest to us that there are still unfilled buy orders left at this price. So we know this price, there are more buyers and sellers. Now, everything in the market is context, right? There's context in the market. So that simply means this is the context of this scenario. We have a strong move away, creating a demand zone, and you could see from that moment forward, the market has not returned to the zone, right? It keeps buying and it keeps selling, it keeps buying and it keeps selling. It's going sideways, right? So what does this tell us? When the market is going sideways, this means that there are relatively equal buyers and sellers, right? We would call this fair value because it's easy for you to get your buys in and your sells in because there's a lot of people buying and selling at the same time. There's a lot of buying and selling going on in this area, right? Because you have buy orders to match the sell orders to send the market up. You have sell orders to match the buy orders to send the market down, right? And the market, could continue going sideways until the only thing that would make the market go up is if there's more buy orders, or down if there's more sell orders. Now the idea here is simple. We know we could identify novice area where there's equal buyers and sellers, and then we could identify demand where we know based on the evidence there are more buyers than sellers. There's an imbalance, right? So once the market comes down to this area, we would expect a reaction because we know this area, there's equal buyers and sellers, relatively. We know this area, there's more buyers. So once the market makes its way down, right, as new sellers come into the market to push the price down to this demand area where we know there's more buy orders than sell orders. Once the market reaches this area and the last sell order is filled, we could expect the unfilled buy orders to come into effect to push the market up until it meets supply or until it meets more sells, right? So just to go over the first what we was looking at, this area right here, you could see relatively equal buyers and sellers. This is where everybody could get their orders filled, right? Now, if you look here, you would see relatively equal, buyers and sellers. Now, at demand, we have more buyers, little sellers. So we could expect the market to go sideways in the novice area, and we could expect the market to go up when there are more buyers than sellers. So if we look here, we would see the result of what happened. So once the market came down to demand, we had a strong reaction because this is the area where there are unfilled buy orders, and we had a strong push up for 1 to 6, and the market actually continued going up from here, right? But that's where I took the screenshot. So range bound and wiki price action suggests that orders are being filled, suggests that the price is relatively balanced. But once we have these strong moves, that tells us that either if it's going up, we have a strong demand, more buyers than sellers, and if it's going down, more sellers than buyers. Now, these are this is another situation with a back tested trade that ran 1 to 6. Same thing as before. All we do is identify, let's call this the novice area. Oh, let's call this fair value, right? We want to identify supply, demand, and fair value. Demand is below fair value, supply is above. Fair value is where the market goes sideways, where there is equal buyers and sellers, and demand is where there is more buyers, and supply is where there is more sellers. So in this scenario, right, we identified so in this scenario we identified rally, base, rally, fair value, the market going sideways. The fact that the market is able to stay away from demand suggests strength. This is a good sign. And the market didn't even pull back, which is an even better sign, right? So we know at this price there's more buyers. We know at this area there is equal amount of buyers and sellers. All right. So once the market comes back to this demand, then we know there's a ton of unfilled orders, right? Now, take for example, this is the market going sideways, right? Equal buyers and sellers. Now, this move right here suggests that the buyers won because the market went up. It stopped going sideways and it went up. Now, the market needs to go up at least 2 or 3 times the zone for it to even be considered, right? So the market went up and it instantly came back. Now the distance that it went up relative to the size of the zone is like 1 to 1, which doesn't suggest strength. This doesn't suggest that before, when the price was equal, when the supply and demand was equal, and demand outweighed supply and pushed the price higher, the strength of the demand was not strong enough to keep the price going. So that would be a weak zone if we was to consider this entire area a demand zone. Now I just use that as comparison to this demand zone where the market just went sideways. This is a 4-hour chart for 8 hours, and then the move away, and it stayed away, was at least 10 times the size of the zone, which tells us how strong the zone is. So once the market comes back to the zone, you can see it barely touched it and it instantly moved away, which is very good, right? When you're back testing, you want to train yourself to find zones that have strong reactions. This tells you that you were successful in picking the correct zone. Now this is another scenario. We have demand, rally away, stay away, rally away, right? And then all of this is fair value, the market going sideways. All of this is the market going sideways. Now we identified an area where we know there's more demand than supply, and we expect the market to react, which it did, right? That's from 1 to 3. Now this one is a good example. We have drop, base, drop. The market stayed away from the zone. Basically supply, fair value, and once the market comes back into supply, we had a strong reaction. Now even in this area, with this drop, we had a base, we had a market drop, consolidate. Now we have fair value, right? Consolidation, wiki sideways price action. So we know this is supply because the market spent a short amount of time here in that base. It stayed away. Once it comes back, you can see we had that reaction, right? So this could have been, a second entry, but it wasn't considered. Now this is just a zoomed out version, and we could see the market headed down to demand right here. Now this was back tested trades. These trades were called out live before they happened in the signal group, in the live session group. So we had S&P right here. We have supply, strong move away. Whenever the market creates a strong candle or a gap, suggests strength. This is the 1 hour time frame. Now, since this move, the market stayed away for a couple days. So as you can see, like this strategy, we find trades days in advance. So days in advance, you could identify these trades and set your orders. Then the market came back, entered at supply, where there was evidence of supply, and moved through fair value. Right here, right? Now this trade was called in advance, sent as a signal. This is NAS 100. We have rally base rally. All of this wiki price action just is telling us that it's fair value. There's equal buyers and sellers. If there was more buyers, the market would just go up. If there was more sellers, the market would go down. But these random sporadic movements is the result of relatively equal buyers and sellers. So eventually the market continued its random sporadic movement until it got to demand, where there was an imbalance. There was more buyers than sellers, and we had that reaction for a 1 to 6 in profit. So it's all about trading your eyes to identify the novice area, to identify fair value and demand. So this trade here was a really good trade. It ran like 1 to 30, right? And it was called out in advance. It was sent as a signal. A lot of us took this trade. So SPX, right? This entire area is fair value. Relatively equal buyers and sellers. This is why the market is moving sideways. This is where you don't want to trade. This is where a lot of people get stopped out. No, this is good for us because this tells us that this zone is very strong. We had this rally-based rally. It was on the 15-minute, but you could see it on the 30-minute. The 15-minute would have been a bit small because usually for supply and demand zones, I would prefer to use more than one candle. So on the 15-minute, there was a couple candles. Now, since this strong move, the market stayed away for several days. It tried to come close, but it never really tapped into the zone. And eventually we had this buy limit set, and the market eventually wicked the zone and ran into profit, and this trade ran much higher. But that was the setup. So we have demand identified, we have novice area identified. Basically, this area, ton of buyers and sellers. This area, only buyers, only buy orders. So that's where we want to buy. Right? So we've already taken up a lot of time. We have these upcoming setups that I was looking at. For the gold, I did this analysis over the weekend. So for gold, we have drop, base, rally, novice area, but the market did not retrace. It already went a lot higher. I basically have this demand zone identified, for when the market eventually comes back there on the 15-minute on gold, but gold is much higher right now. This is the trade ideas from the 11th of August 2024 to the 18th, right? That's a week. We have GJ, waiting to see the outcome. We have demand, right? Strong move away, novice area, supplies all the way up here, so we have a lot of room for profit. So should the market make its way down to this demand zone, we would enter bias to go higher. We have USD CAD. We have USD CAD reacting off of this. This is a little demand zone right here, but I'm expecting it to be removed. So we have a supply zone here, drop, base drop. We have the novice area. So what we're expecting is the market to come up, react, and continue to drop. Now, what makes the trades higher probability is the more profit margin, the more space there is compared to the zone. So for example, if you have a base, right, a drop, and then a novice area far away from the base, when it comes back up to the base, it makes it higher probability to drop. Now, because this fair value novice area is very close to the base, makes the probability lower, but it could still work, right? Now, in this one, we have drop, base, drop on the 1 hour and NZD USD. The market continues to drop. We have the novice area. We have another novice area of fair value. We know, based on observation, we know at this price, there's potential for there to be more sellers than buyers based on the context and everything we went over, because this is supply. And then we know also this would be demand because we have a strong rally, base rally. We have basin right here. So if the market was to come down to this area, we'd expect a reaction. If the market was to come up to this area, we would expect a reaction. So we'll see what happens in the next video. But that's the idea. And we know this because we've tested it on many trades, right? So hopefully you find the time to practice this, and you know it's a great trading strategy. So have a good day, guys. Make sure to back test, make sure to study, and make sure to follow your trading plan.